Gentlemen, good day and welcome to the Q2 and H1 FY24 results conference call of the Phoenix Mills Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Management of the company is being represented by Mr. Shishir Srivastava, Managing Director, Mr. Anurag Srivastava, Group CFO, and Mr. Varun Parwal, Group President Strategy and Corporate Finance. Should you need assistance during the conference call, please signal an operator by pressing star followed by 0 on your touchtone phone. Please note that this conference is being recorded. At this time, I would like to hand the conference over to Mr. Shishir Srivastava. Thank you, and over to you, sir.
Good morning, ladies and gentlemen. We take pleasure in welcoming you all to discuss the operating and financial performance for the second quarter and half year ended September 2024. We hope that you've had a chance to look at the results presentation shared by us. The same is uploaded on the stock exchanges as well as on our corporate website. I will now take you through the key highlights of the results with reference to the relevant slides of the results presentation. Over the last 10 months, we were tasked with launching 4 million plus square feet malls, and today we are extremely proud of having delivered these world-class experiential developments which set new benchmarks in retail and mall design. Starting with Phoenix Mall of Asia, Bangalore, if I may draw your attention to page 3. We launched this mall on October 27th with over 440 national and international brands, complete with India's largest international luxury watch cluster, a wide array of entertainment and dining options complemented with beautiful and captivating interiors and decor. We expect Phoenix Mall of Asia not only to be a luxury destination for Bangalore but a complete family destination and become the true landmark retail asset for the entire south of India. As of the end of October, the mall was operating with a trading occupancy of approximately 43%, and we expect this to inch forward towards the second half of this financial year. From our experience, the ramp-up that we have seen at Phoenix Citadel Indore or Phoenix Palladium Ahmedabad, we expect Phoenix Mall of Asia to be at a trading occupancy of approximately 75% by March 31, 2024. Next up is Phoenix Mall of the Millennium at Wakad, Pune. You may see page number 7. We launched Phoenix Mall of the Millennium on September 1st, 2023. The mall is home to over 350 national and international brands, an entertainment zone of over 1 lakh square feet with various attractions such as a fan park, entertainment centers such as Time Zone and Fun City, a 14-screen Inox multiplex, and over 75 dining options, with the food court having a capacity of more than 550 people. Trading occupancy has shown a strong ramp up since launch and stood at 50% in October 23 versus 44% during September, with about 177 stores now operational. We expect this trading occupancy to inch up to about 80% by March 2024. On page 12, we have Palladium Ahmedabad. This asset, which was launched on 26th February 2023, marked our entry into Gujarat with the trading occupancy again has seen a fast ramp up from 32% at launch in February to 77% in October 23. Moving on to page 13, Phoenix Citadel Indore was launched in December 2022. Here again we have seen the trading occupancy ramp up from 42% at launch to about 90% as of October 23. Now on to a quick update on our under development retail assets. If you may look at page number 14 and onwards. Phoenix Grand Victoria, Kolkata. We have received all development permissions. We have also completed the pre-construction activities and currently excavation and foundation work is under progress. Our second retail destination in Gujarat at Surat, we expect the construction to commence in Q3 of FY24. At the retail expansion for Phoenix Palladium, Mumbai, spanning across a GLA of approximately 250,000 in the current phase, civil works have reached an advanced stage, and we expect to complete this project by about March of 2024. Moving on with our retail portfolio performance for Q2 FY24 from page 17 onwards of the presentation. Consolidated consumption, which represents net sales reported by the retailers at each of our centers. At a portfolio level, for the quarter ended September 23, consolidated consumption stood at 2,639 crore with a growth of 20% over the same period last year. To compare this growth on a like-to-like basis, if we exclude the contribution from the new malls launched, which are Phoenix Citadel, Palladium Ahmedabad, Phoenix Mall of the Millennium, and adjust for the impact from closure of the lifestyle store at Phoenix Palladium, Mumbai, the consumption has grown by about 10%. Turning to page 21 onwards for the financial performance of our retail portfolio for the year so far. For Q2 FY24, retail rental income stood at 392 crore, up 25% when compared to Q2 FY23. Q2 FY23, and 8% on a like-to-like basis, excluding the new malls launched. Retail EBITDA for this quarter was 402 crore, up 26% compared to Q2 FY23 and up 11% on a like-to-like basis. For H1 FY24, retail rental income stood at 769 crore, up 21% compared to H1 FY23, and up 6% on a like-to-like basis, excluding the new malls launched. Retail EBITDA for this period was 789 crore, up 23% compared to Q2 FY23, and up 9% on a like-to-like basis. With the onset of the festive and the winter season now for FY24, we look forward to a fabulous performance in the second half of the year as well. May I now request Anurag to take you through the office, hotels and residential section and the overall financial results.
Thank you, Shishir. Good morning, everyone. Please refer to page 27 onwards for update on commercial offices. Our commercial office portfolio is seeing improving traction with gross leasing of over 3 lakh square feet in the period from April to October 2023, with about 2 lakh square feet of new leasing and 1 lakh square feet of renewals. Total income from commercial offices in Q2 FY24 stood at 47 crores, up 9% compared to Q2 FY23. And total EBITDA stood at 26 crore with a growth of over 6% over Q2 of financial year 23. During H1 FY24, income stood at 91 crores, which was up 9% year-on-year, and EBITDA was 52 crores, up 7% year-on-year. Moving on to update on under construction commercial offices projects from page 31 onwards. We are progressing well on our development of 3 next leg of growth in commercial offices. At Phoenix Asia Towers, lobby and common area finishing. Facade work is underway. The first phase of these offices, about 800 million square feet, or 0.8 million square feet, is expected to be operational during the current financial year, i.e. FY24. Millennium Towers, Wakad, slab work is in advanced stages for the office towers. At the Palladium offices at Chennai, we target completion in FY25. We have also received US GBC LEED certification with gold rating. For Project Rise, all development permissions have been secured, foundation work has been completed, and basement slab 2 has also been completed. As far as the commercial office component within expansion of our mixed use asset in Whitefield is concerned, excavation work is nearing completion. Moving on to the hotel portfolio from page 37 onwards, first covering St. Regis, Mumbai. We continue to see significant improvement in our performance. ARR in Q2 FY24 was about 15,040 rupees, and in H1 FY24 it was 15,767 rupees. Both showing an increase of 27% and 32% respectively over previous year. Total income for Q2 FY24 stood at rupees 102 crores with growth of 20% over Q2 FY23 and at rupees 213 crores for H1 FY24, up 39% over H1 FY23. With the increase in total income, EBITDA margin has also improved to 43% in H1 FY24 compared to 40% in FY23. At our property in Agra, Courtyard by Marriott, ARR in Q2 FY24 was at 4,196 and in H1 FY24 it was 4,303, both showing an increase of 8 and 13% respectively over previous year. Total income for Q2 FY24 stood at 9 crores, up 7% from Q2 FY23, and EBITDA stood at rupees 1 crore, up 7%. Total income for first half 24 stood at 20 crores, up 20% from last year, and EBITDA stood at rupees 3 crore, demonstrating a 19% growth. Our residential business update is from page 44 onwards. We continue to witness very good traction in residential sales. We have completed gross residential sales booking of 495 crores in year-to-date October 2023, which is already higher than gross sales booking of rupees 466 crores done in FY23. Same goes for collections, which stood at 423 crores in year-to-date October 2023, surpassing the full year collection of rupees 369 crores seen in FY23. We have built and delivered 2.83 million square feet across One Bangalore West and Kesako, of which we now have only about 5 lakh square feet of unsold inventory left. At our under development premium residential project at Alipur, Kolkata, consultants for various work streams have been onboarded and we are in the process of obtaining our development permissions. I would like to now move to financial results from page 47 onwards. Some of the key highlights of our consolidated financial performance are as follows. Income from operations for Q2 FY24 stood at 875 crores. This is up 34% year-on-year, and at 1686 crores for H1, up 38% year-on-year. Operating EBITDA for the quarter stood at 514 crores, up 35% year-on-year, and 1006 crores for first half, up 43% year-on-year. Reported PAT after minority interest and after comprehensive income for Q2 FY24 stood at 262 crores, which is up 40% year-on-year, and stood at rupees 531 crores for the first half. Debt position from page 49 onwards. Consolidated gross debt stood at 4,263 crores as on 30th September 23, down by 311 crores since March 20. 97% of our gross debt is on operational portfolio with very competitive average borrowing rate of 8.71%. Currently, our lowest cost of borrowing stands at 8.5%. Despite RBI increasing rates by 250 bps since March 2022, our borrowing costs have gone up only 141 bps so far. As the overall interest rates in the economy start to rise, our effort will be to minimize the impact of this on our cost of borrowing by reducing the spread charged by the banks on top of the repo rate. Cash flows from page 51 are H1 FY24. We generated about 1,060 crores of net cash from operating activities, and our operating free cash flow stood at 882 crores. Liquidity position from page 54 onwards. Group level liquidity on 30th September 23 stood at 2,166 crores, up by 411 crores from the position as on 31st March 23. This excludes the amount remaining unutilized in OD accounts. Net debt stood at about 2,096 crores, down by 186 crores from a position as on 31st March 23. We are bullish on our business prospects, and with a strong balance sheet position, our focus remains on delivering our under construction projects on time and judiciously deploy our capital to expand our portfolio. Thank you.
Thank you very much, sir. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and one on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and two. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Resham Jain from DSP Asset Managers. Please go ahead.
Hi, good morning, team. So I have just a couple of questions. So first one is, if you can just help with your overall capex to be incurred over the next 3 years based on the current development which you are going to do.
Hi, Resham. So
Hi.
between now and 2027, from the projects that are already announced and updated on the presentation, we have a further capex of about 4,800 to 5,000 crores that is left. And now this is between current calendar year and up to 2027. This includes 3 million square feet of retail that's under construction at various stages, and over 5.5 million square feet of commercial offices, as well as the residential development planned at Alipur.
Okay. And the overall, let's say, if I look at the cash generation over the same period, the cash generation seems to be significantly higher than this number. So how are we thinking about the incremental cash which we are going to generate? Are we further going to, because our debt levels are at a reasonable level now, at net debt. So just your thoughts on the same.
You're right, Resham. I think with the excess cash, we'll continue to sort of build our retail portfolio, look at further business development opportunities. Retail continues to be our flagship business, and we see a lot of opportunities in expanding in cities where we already exist, as well as the new cities in other towns. So that's the focus, and of course, as the retail assets come up, we'll also continue to focus on the mixed-use development. I'll just passing it on to Shishir for further comments.
So, if we just look at the current run rate, Resham, we see about 2,000 crore of free cash being generated annually. And as Varun mentioned, we have about 5,000 crore of capex for projects which are already under development and already announced. We continue to look for opportunities for expanding our real estate, retail and residential and office verticals. So I think we are on a good path to look at deploying significant free cash in new projects, in acquisition and development of new projects.
Okay, understood. The other question I have is on residential. Will you have the post-tax IRR, let's say, of the Bangalore residential project, which is now about to get over, let's say, in 24, 25? What will be your approximate post-tax IRR in that project, residential?
So, Resham, if you look at how the project has moved, and especially in the way the prices have moved, we launched this project back in 2012 at a price of 5,500 rupees a square feet on launch day. And today, in October, we have taken the selling prices to above 21,000 rupees on a per square feet basis. We, of course, had incurred land cost, etc. back in 2012, but then we utilized the base FRI to construct the first 5 towers and return all the capital back. So the company had received full return of its entire equity investment back in 2014-2015 itself. Kesaku has been launched thereafter, and we have purchased development potential and incurred construction cost, to construct this. Residential project, if you look at it from the markup that we see on our construction cost today, our landed cost of development for a premium residential tower is at 7,500 to 8,000 rupees a square feet for a Kesaku sort of a development wherein we provide a lot of lifestyle amenities. But the selling price that we have is, in excess of 20,000 rupees. So from a capital multiplier, it's a significant improvement, and that also results in a good post-tax IRRs of, our targeted IRRs of 18 to 20% on a post-tax basis.
Okay. Thanks. I'll come back in the queue. Thanks.
Thank you so much. The next question is from the line of Puneet Gulati from HSBC. Please go ahead, sir.
Yeah, thank you so much, and congratulations on good numbers. My first question is on your office project. So the Bangalore and the Pune one are close to completion and set to launch. Can you elaborate on what is the progress on leasing there, and how are you seeing the market?
Hi, Puneet. Good morning. Puneet, we are expecting the OC for the offices at Bangalore, which are Asia Towers, shortly. So we've not been able to execute any leases, but I can talk about the pipeline. We've seen a significant pipeline, and the profile typically is for 2 lakh square feet and or thereabouts for each tenant.
Okay.
So if we just look at the cumulative pipeline, it's about close to about 2 million square feet of pipeline, and several of those are waiting for conversion. At this point in time, I think we feel fairly confident that within about 12 months of the OC coming in, we should have about a 75% kind of an occupancy within development. This is across 800,000 square feet. And for Pune, we are expecting the building completion for Millennium Towers for the first phase to be in August of 2024. And again, we are looking at what is the pipeline there. There seems to be significant demand for this part of the city.
Okay. And so I thought the total area, leasable area, was 1.2 million, right? And you said 0.8.
So at Bangalore, we have a further 250 odd thousand square feet of FSI potential there, which we have not built out as yet because of the not having the clarity on the TDR policy in that city. So we have about almost 400,000 square feet of GLA, where in one of the towers where we have the ability to construct once that becomes clear.
Okay, so you're building 0.8 in Bangalore and similar 0.8 in Pune as well?
0.8 in phase 1, 0.4 in phase 2 in Bangalore. And in Millennium Towers, it's a total of 1.4 million square feet GLA, which we are building out. It's just that the first tower will become ready in August of 24. And the next one will be ready by maybe about January of 25 or February of 25, somewhere in that period. Cumulatively, this is about 1.4 million GLA at Millennium Towers.
Okay. And can you also indicate what kind of rentals are you likely to negotiate there?
So, looking at that competitive landscape in Wakad, the numbers currently are at around 75 rupees per square foot. I believe that our product is a front office, premium grade A, LEED certified product which will command premium rentals. So 12 months from now, we should be in the region of about 85 rupees or thereabouts would be our starting rent.
And Bangalore?
Bangalore is also going to be around 85 rupees as the bare shell rent.
Okay, that's it. And secondly, on this land purchase, I might have missed it. I joined a bit late. On the land purchase, what are the thoughts? What do you want to develop on in Thane?
Puneet, as you are aware, I think the competitive landscape there has quite a bit of retail. So we are evaluating what is the ideal development mix. We've also seen that despite the inventory overhang on residential, we've seen that the good grade A quality residential has outperformed in that market with rates in excess of 20,000 rupees a square foot. So we are evaluating the ideal development mix for this location, and we are certainly cautious about the competitive landscape in retail. So I think we are going to take another 3 months or thereabouts to define what we are going to finally build there.
But you would have done some IRR calculation, right? And what would that have been based on?
So we've looked at various scenarios. We've looked at mixed-use development with retail in the lead. We've looked at residential. We looked at a combination of residential, and I think the returns work in any scenario in terms of our return expectation on equity. I think they work in any scenario, but the risk is probably as I mentioned, the competitive landscape one has to be very cautious about. So we are evaluating whether we want to take that risk or we want to mitigate that risk and go with a residential kind of a development. Residential development with ancillary retail. But we have not decided, and we at this point in time, my answer to you is that we will take 3 months or so to decide on the development mix.
Understood. And just on the broad question, I know you've answered it to a certain extent, but how are you looking at deploying the huge amount of free cash flow that you will be generating? Should we expect anything in next 1-2 years to get added, and in which geographies?
Adding new developments is routine for us. That is what that is how we are growing. And we continue to be very, very aggressive in terms of our land, evaluating land opportunities in some of the key markets. In some of these markets, there were auctions announced which then got cancelled. But so we are actively looking for land in 4 or 5 different key markets that we have identified where we want to be. So as we have done in the last several years, we will keep acquiring and delivering at least 1 million square feet of retail every year or thereabouts.
Right. Okay, but you have to spend close to at least 1,000+ crore every year, right? So that's a large sum to spend as well.
Yes, it's a large sum to spend, but I think it's good to have that kind of an ammo to go and buy the most premium land parcels for the most premium development in these cities. So land cost is not low, right?
Yeah.
And we want to also keep our debt levels in check while we pursue these opportunities or pursue expansion opportunities at our existing development. So we will be very judicious about how we utilize our cash flows.
Understood. That's helpful. Thank you so much, and all the best.
Thank you.
Thank you so much. Ladies and gentlemen, in order to ensure that the management will be able to address the questions from all participants in the conference call, please limit your questions to 1 or 2 per participant. Should you have a follow-up question, please rejoin the queue. The next question is from the line of Kunal Lakhan from CLSA. Please go ahead.
Yeah, hi. Good morning. So on, when I look at your trading occupancies in the last 12 months, right? I mean, across your assets, they've increased from say 4 to 8%. And then when I look at same-store consumption, it's grown by 10%. So, adjusted for the occupancy, trading occupancy, is it fair to say that the consumption growth, like to like same-store, would be about 4%?
Hi, Kunal. Varun this side. So, I think on your question first on trading occupancy, We have had a very strong lineup of retailers who have either entered India or expanded into India, and we have been accommodating them in our malls over a period of time. And we saw a number of them opening up in September, and further more followed up in October as well. And this I'm referring to only the existing operational portfolio. So today, our asset like a Phoenix Market City in Bangalore, which was launched in 2011, is trading at a lifetime occupancy of 98%, and we have a very, big lineup of brands who we are still waiting to accommodate in this mall. That said, a number of these retailers have recently entered and opened in the mall, and their performance in the first 18 months takes time to ramp up and start contributing meaningfully to the overall trading density perspective. If I look at, say, malls where the new retailers have been operational for some time, I would say that Phoenix Palladium has seen a trading density growth of 7 to 8% year on year on a like-to-like basis, whereas a Phoenix Palacio has seen a like-to-like growth of over 14% if I am looking at same-store sales contribution. And we see the strong high single-digit contribution from stores across our existing operational portfolio. We have also, to share some light with you, we have also given a category-wise breakup in the presentation, wherein on a like-to-like basis, the overall portfolio has seen a 10% growth, and this contribution has been led by jewelry, which has grown at 25%, by F&B, which has grown at 12%, and of course multiplexes, which have had their best ever quarter at 22%. We have also seen a recovery in hypermarkets. I think some of the legacy issues that we have faced in the hypermarket performance in FY23 is starting to get addressed and resolved. It still remains way below what we have seen compared to pre-COVID levels, but it is starting to improve from the low basis that we saw in FY23.
So fair to say that whole catch-up will happen in subsequent quarters when these newer tenants will kind of, their consumption normalizes.
Absolutely. We had Uniqlo open recently, and which was in October. Now that's certainly going to add significantly to the overall consumption in that area. Plus, I think also now with this festive season, it's going to be a good way to track against what the consumption was last year for the next 3 months, October, November, December. I don't think that there is any sentiment or structural issue that we are seeing impacting the consumption in the mall. Last quarter, certainly we did see an impact, but I don't think in the long term. I think in the long term it will balance out. So this next quarter is very key for us.
Sure. My second question was on, again, the Thane land. I mean, in the past, we've been very clear in terms of, when we buy a land, there's always a end-use planned, strategized, But this seems a little different, in terms of, we bought the land, but even not yet sure whether, we'll build retail or residential. Just wanted to understand the thought process behind acquiring the land.
Kunal, it's a landmark location, okay? It does not take away from our confidence in building a fabulous retail best development there, but there is significant competition, and there are quite a few of our brands which are already occupying retail space in these other malls in that vicinity, right? So while we've been able to, I think we acquired this at a fair value, the land. We want to figure out what is the best return for our efforts and our investment into this land. Hence, we are evaluating other asset classes which are where the risk on the return estimates are much lower. So that's the only point here. We have evaluated this for a retail-led mixed-use development, and it does meet our returns profile, but there are risks associated with that. So we are looking at the ideal development mix which mitigate any risks to the return.
Sure. Any idea on the potential leasable area or saleable area, potential that this land would have?
Let me tell you that the overall development potential is 3 million square feet, or slightly higher than that actually. We may have to slice this up into 3 or 4 different asset classes, and clearly, so that is what we are trying to really figure out at this point in time.
Sure. Thanks. I'll come back and take you. Thank you.
All right. Thank you.
Thank you. The next question is from the line of Murtuza Arsiwala from Kotak Securities. Please go ahead.
Just a sense, how much money is already being spent on the projects? You talked about another 4,800 crore that is to be spent. How much money is already spent on these projects? That's one. And second, for a lot of projects that have been commissioned, you have co-ownership. Is there any sense or understanding with the partners in each of these individual projects on the fungibility or utilization of cash that these operational malls now throw out?
Murtuza, I will take the first part of your question. You spoke about how much we have spent on these various assets so far. So for the malls that have opened up, as well as the money that we have spent on offices and retail under construction, we have cumulatively spent about 6,000 crores from 2018 till now on these assets. And we can of course connect offline and share asset-wise details if required on the amount spent on each asset.
Sure. And on the second question?
Your second question was on the ability to upstream cash flows from
That's right.
From SPVs with JV partners. No, so we are looking at currently the JVs that we have with GIC. We are earmarking the free cash being generated from there to be invested or deployed in a new acquisition, 1 or 2. In the other JV which we have with CPPIB, we have ongoing expansion. So a bulk of this 5,000 crore of future spend is going to be in these SPVs or in the partnership with CPPIB. So we are looking at the most efficient way of utilizing those cash flows for that expansion.
So if I understand that right, for instance, the Bangalore Mall or some of the more recently commissioned malls in Bangalore, Pune, which are in partnership with CPP under a separate SPV, the surplus funds will go, let's say, in a Kolkata Mall, which is a separate SPV, but still the same thing.
So Bangalore, we have a significant expansion, right? We are building a 300 plus key Grand Hyatt hotel. We are building 1 million square feet of offices, plus we are expanding the retail at the Bangalore Mall. So that SPV in itself will have a sizable capex out of this 4,800 that Varun outlined for you. Similarly, I would say that with the new malls opening, Mall of the Millennium at Pune, it's going to take time for the cash flows to build out. And we will evaluate when we see significant free cash being generated, we'll evaluate mechanism of how that can be upstreamed or how that could be utilized for. And sorry, let me also clarify, Mall of the Millennium, currently we may have spent only about 70% of the overall project cost for the mall alone, and we are still incurring expenses on the office development. So any free cash that gets generated there will get utilized in that development first. Mall of the Millennium, we've probably spent about maybe 60% of the overall project cost. So free cash getting generated there will get utilized for the capex and completion of the offices, etc. So the cash utilization in terms of capex is already pretty straightforward and identified for the next 3 years.
Sure. Thank you.
Thank you. The next question is from the line of Biplab Debarma from Antique Stock Broking. Please go ahead.
Good morning, and wish you all a very happy Diwali. So my first questions on the Alipur and project, right, sir? From when do you think we'll see a rental generation from these two assets, the Alipur and the project, right?
Hi, Biplav. So Project Rise is right now at the excavation and foundation stage. We have completed the excavation and basement 2 is completed and we are now working on basement 1. I would say that the project is about another 36 months away from generating rents, with retail maybe starting a few months ahead of offices. Calcutta, at this point in time, we are coming out of the ground. Excavation is completed there, and the mall, I would say another 36 to 40 months for the mall to become operational from today.
So FY 27-28 for both Alipur and project, right?
26, 27, I would say, for both Alipur and, yeah.
Okay. And my second question is on the, most of the major cities that your focus is have a quite decent number of malls. And as you enter into these cities to deploy your huge cash flow that you are generating, I think you'll see such competitive landscape as you are seeing in Thane. So, sir, going forward, shall we incrementally see mixed-use development? That currently you are evaluating in Thane.
Biplab, may I request you to just explain your question again, please?
So, sir, basically,
I'm sorry, sir. I believe the line got disconnected. Just give me a minute. I will get him connected.
Can we continue with the next individual in the queue?
Okay, sure. So the next question is from the line of Parvez Qazi from Nuvama Group. Please go ahead.
Hi, good afternoon, and thanks for taking my question. So on the resi portfolio, considering that we now just have about 0.5 million square feet of inventory left, any thoughts about launching Tower 8 and 9 in Bangalore? And also related question about the residential project in Calcutta. When can we see a launch there?
Hi, Parvez. So Towers 8 and 9 at Bangalore, we will only announce or launch once we are able to proceed with the TDR loading on the layout, which currently, as per policy, there's some ambiguity. Right, so we have, but again, I think it's a hugely anticipated launch in that micro market, and as much as we are looking forward to the launch, we know that there's a huge customer base that's looking forward to this launch. Calcutta is at design stage. I think we may be about 6 months or so away from announcing the launch.
Got it. Thanks and all the best for future.
Thank you.
Thank you so much. The next question is from the line of Pritesh Sheth from Motilal Oswal. Please go ahead.
Yeah, hi, good morning. Thanks for taking my question. Firstly, on slide 69, where you have given the expiry details. So based on that data, if I calculate roughly 4 million odd square feet of space in these malls are going to come up for expiry over the next 3 years, roughly 1 million square feet each. So, how should we look at, rental growth in these, once these are set for renewals? Yeah, that's my first question.
Hi, Pritesh. So I think you're right. And, the idea of putting out a renewal schedule is also for us to plan and see how we can improve upon the brand mix and the category mix inside our malls. If you see over the last 4 years from pre-COVID to now, We have significantly enhanced the presence of newer, faster growth categories, whether it's in cosmetics or jewelry or in fashion, by replacing, by creating space for new assets and new brands entering the country, and also increasing the experience-oriented components such as F&B and relooking at how F&B is run inside the malls. Over the next 3 years, the pipeline that we have allows us to continue to revamp and ensure that our existing assets drive market-leading growth, and they continue to stay very relevant for the new age consumers and the discretionary consumers as well.
If I may top up over there, see, for us, it's routine to see every mall go through this renewal or end of contract cycle. So at an average, we would see 15 to 20% kind of a renewal across our or a end of contract across our portfolio every year. In some years, it may spike up because of anchor, which are anchor agreements coming for end of contract, etc. However, we see, our learning has been over the last 20 years, and we've tried to implement this learning, that every such spike where you may see in a year 25-30% of an area coming up for end of contract, it presents us with a huge opportunity to evolve that asset by making significant changes on the experiential side, maybe circulation related aspects, addressing those which we learn over a period of time, and also changing the brand mix a little. So over the years, as the asset evolves and these renewal opportunities or end of contract opportunities arise, we get the ability to move certain brands to other locations where they will be more successful, and freeing up that location for a newer brand or a higher positioned brand. And this is across the life cycle of the asset. Year after year it evolves, and the premiumness of the overall offering keeps moving up. Sorry for that lengthy answer to your short question.
No, thanks for the detailed explanation. But in general, since most of these assets are up for renewal after 10 years of operations, right? So hence, major reset would obviously be expected in terms of rentals as well. So as per your experience, how much should that reset be versus a usual 5-7% kind of contractual?
So firstly, the cycle is not 10 years. We see it that we see a spike coming every 5 years, and at an average on an annual basis, about 20% of the area gets 15 to 20% of the area gets end of contract. At end of contract, typically we see a significant catch up on the minimum guarantee rent. So minimum guarantee rent moves up to maybe a slightly higher than what was the actual rent received on account of revenue share. Yeah. So at that point, typically in a renewal, we may see about a 15% kind of an increase in minimum guaranteed rent. And if it's an anchor space, let's say that we reorganize to smaller stores, in those scenarios, the delta could be as high as 50-60% as well in terms of rental increase. But on a portfolio basis, you can assume, a 15 to 20% increment in the rent. So whatever was the last rent paid by a particular brand, when we release that store at end of contract, we expect a 15 to 20% increase there.
Got it. Very clear. Second question on your consumption guidance that you gave of 11,000 crore at the starting of the year. We have already done, I think, roughly 5,200 odd crores. You will stick to that guidance, or there's an upside potential to that?
I think we may be a little ahead of what we may have estimated for H1, because now the festive season kicks in, and this is really, I think we're all super excited to see how the next 3 months perform.
Sure. Got it. And just lastly on, Thane again, since it's, Sparkle 2, which is, the subsidiary, and Sparkle 1, we have a JV with CPPIB. So this is also with, in partnership with CPPIB that we are acquiring this Thane land?
No. I'm clarifying that Sparkle 2 is 100% subsidiary of Phoenix Mills Limited, as was Sparkle 1 before when it was created, and then it was used with CPPIB coming into and investing into Sparkle 1. So Sparkle 2 is a 100% subsidiary. It's not connected to the CPPIB JV in any way.
Sure. But would one of the two partners be interested in coming up with us for that land? Depends on the mix, I guess.
Yes, that depends on the development mix.
Okay.
Which at present we have not finalized, as I mentioned earlier.
Got it. That answers my question. Thank you. All the best, and wish you advance happy Diwali to you and your team. Thank you.
Happy Diwali to you too, Pritesh.
Thank you so much. The next question is from the line of Kunal Lakhan from CLSA. Please go ahead.
Hi, thanks for the follow-up. Shishir, we had earlier highlighted that we'll be looking at acquiring 2 land parcels a year. Just wanted some clarification on that. The 2 land parcels would be towards retail, and over and above you'd look at say for the residential expansion, or it's 2 land parcels in total, and it could be either residential or mixed or retail.
No, our goal is, as I mentioned many times previously, Kunal, in the last several years, our goal was to, after 2024, when we've delivered all the projects that we had, undertaken in FY17, our goal was to deliver 1 million square feet after 2024 of retail every year. So I think we are well on track to achieve that, and we will continue to buy 1 or 2 land parcels for retail every year.
Mm-hmm.
Yeah.
Got it. That's what I wanted. Also, just secondly, on the first CPPIB platform, now that most of the assets with say Bangalore and Pune, commencing operations, most of the assets under the first platform are operational. What would be the exit strategy for CPPIB, and also in terms of our interest, would we look at buying back stake as a part of CPPIB's exit strategy?
So Kunal, while the malls have become operational, the other asset classes being developed on those same land parcels continue to, for the next 2 to 3 years, the project continues. So at present, we are still in active development in the CPPIB JV with the office expansion, the hotel at Bangalore, additional retail area being added. And no, there is absolutely no discussion on exit or any exit strategy at this point in time with CPP.
Sure. Thanks so much, and all the best.
Thank you.
Thank you. The next question is from the line of Biplab Debbarma from Antique Stock Broking. Please go ahead.
Yes, sir. So my earlier question was going forward, as we keep investing in new land parcel in the major cities, do you see that we would be doing mixed-use development rather than purely, kind of retail focus because of the high competitive landscape as we were seeing in Thane? Or Thane is just one of the incidences that we are seeing?
Thane may be an aberration because it is already a very dense micro market and with significant competition. So,
Okay.
Yeah.
Okay. And second question is on the so our focus, as you rightly said, in the focus would be on the pure play retail and opportunistic investment in other segments of real estate. Your focus continues to be retail. Is that correct, sir? That my understanding, sir?
Biplab, if I may explain this to you. See, there are certain markets, or rather across the country today, land parcels have much more development potential, which one cannot consume entirely for retail. So even if we acquire a land which is focused for a retail development, we will consider other asset classes to exploit that maximum potential on the FSI. What that asset class is will depend on what is the demand in that particular city and in that market.
Okay. Great, sir. Thank you, sir, and wish you a very happy Diwali, sir.
Thank you. You too.
Thank you so much. The next question is from the line of Atul Mehra from Motilal Oswal Asset Management. Please go ahead.
Yeah, hi team. Good morning and thanks for the opportunity. So just one question in terms of with this outlay of 4,800 crores till FY27 that we mentioned, and given that along the way we will have renewals and escalations with existing customers, what is the likely operating cash flow trajectory we will get to, in your opinion, in the current 2,000 crore number that we had? Can this be more like 4,000 crores if we were to go by the current plan?
Atul, tricky question because I don't think we can give a guidance such as this.
No, not a guidance, based on calculation.
But okay, I would say that analysts have presented to us that we are really best placed, to give you this computation. But you would not be off the mark. I can say that you would not be off the mark of what their computations are showing. Would you like to tell us what you are estimating?
4,000 crores.
Yeah, I think that's a healthy target, and we will definitely try and beat it.
Great, sir. Great to know. And then secondly, in terms of like we're talking about retail expansion going forward and deployment of the free cash flow that we generate. So if we were to look at some of the next in terms of cities, next set of cities versus what we have the top tier 1 cities in some time. So is there in your opinion a viable model to go to the next rung of cities, maybe with a more in terms of improvised retail square footage, and any exploration on that side which can further expand our target market?
Atul, I think our strategy is clear of creating these experiential centers which become attractive for like a region. So when you look at what you call a tier 2 city, and we would call it a tier 1 opportunity like a Lucknow or an Indore, these malls are not just malls for those cities. We are seeing people, we are seeing our customer base extending to 100 kilometers from that city, which goes into the smaller towns as well, where there is significant amount of wealth. So I would say a city like Coimbatore presents that kind of an opportunity, right? With 5 or 6 major towns, which could become which are its feeder markets even today. A city like Vizag is an interesting opportunity. Chandigarh has always remained an extremely exciting opportunity. Jaipur is another such city. So these are the cities that we have previously identified during our interactions, and we continue to look at opportunities there as well.
Got it. Great, sir. Thank you and all the best.
Thank you.
Thanks so much. As there are no further questions from the participants, on behalf of the Phoenix Mills Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.